There have been some precipitating factors, right? We had Anthropic rolling out some new products. We had OpenAI rolling out some new products, which rekindled perhaps these concerns that AI is going to eat software. But it wasn't just software falling, right? It was broader in tech. As we all sort of try and wrap our heads around what happened this week, what are you thinking about? What's top of mind for you?
Yeah, it's interesting. If you look at the broader markets, I mean, we're really not that far from all-time highs, but it feels much worse because, to your point, there's been a lot of damage under the surface, particularly in what we'll call kind of high beta momentum names. We've seen a significant reversal in their performance. So the best performing stocks over the last week, or the best performing stocks over the last year, have some of been the worst performing in the last week, and those that were out of favor have now come back very aggressively. And there's a few factors at play here. Some of it is that if we look at the sort of cohort of both hedge funds and then retail investors, many people have loved these names. And when we see sort of the impact that Claude announcements have had on software, that starts bleeding through to the broader market, causing a lot of turbulence under the surface. So I think we're at a period where there's going to still be some digestion of exactly where positioning falls out, because there's a lot of technical factors at play when you have leveraged ETFs, zero-dated options, all in the same trades. The second that begins to crack, the pain can kind of exuberate very, very quickly.
Yeah, and that's definitely what we've seen happen. I do want to point out as well, even that IGV ETF, which is one that we're watching really closely, which is sort of software plus, right? That is down about 12% this week, the worst since 2008. But the sell-off didn't start this week, as you well know. That IGV actually hit a record back in late September, and since then has fallen by more than 30%. And I wonder, I think about sort of Liberation Day, there was a big decline in software stocks and everything at that point. But the sort of key there was the unknown, right? What is tariff policy going to look like going forward? And it seems like the unknown here, nobody really knows which businesses are going to be disrupted on what timeline and by how much. So if you don't know that, can you come in, can you step in and buy any of these names with any confidence?
Yeah, look, on one hand, market corrections are actually quite normal. They're healthy. We need them actually for the market to be on strong footing to continue moving forward and grinding higher. What's a little bit scarier this time around is exactly to your point. Around last year, if we recall, in February, we had the DeepSeek news. Tech AI stocks fell really sharply, thinking there was no longer going to be demand for NVIDIA chips. Then we have Liberation Day sell-off, then a huge reversal. This time around, it's unclear exactly what the catalyst would be for the market to recover very quickly. So I think investors are starting to question, is this actually more of a DeepSeek Liberation Day moment? Or is this more like 2022, of course, when we had Meta's concerns really bringing down the broader tech sector? What's interesting this time around, though, even if we look at Amazon's results, of course, they were mixed, not really a clean beat, but AWS came in better than expected. These companies are generating, particularly the Magnificent Seven and mega cap tech, unbelievable amounts of revenue, growing and accelerating that revenue at strong paces, which just simply by the law of big numbers is sometimes hard to fathom. But the real concern is, what does the future look like? We know that Amazon guided to 200 billion of GDP. That's roughly the GDP of Greece. If we look at all the hyperscalers, they're now projected to do over 600 billion in GDP. That's the GDP of Sweden or the GDP of Massachusetts. So the numbers are massive. And I think investors are now kind of really being more discerning of saying, well, hold on, I thought we were going to start seeing return on investment in 2026. Now you're telling me there's more spending. So people are really pulling back before they begin to say, how much do I want to value a company, even if it's growing, knowing that they're moving from a capital light industry to maybe more capital intensive industry.
And Dave, I wanted to play for you some of the commentary that we've been getting throughout the week, kind of looking at what investors should do now, how they should be reacting, and then you and I can chat about it. So here's what a few folks had to say.
We actually think that software companies are overly maligned right now. They do provide very valuable services to their customers. They're still very good businesses, growing fast with good margins that can scale well and are hard to switch out of.
What we've been telling people even coming into the year is like, look, let's start to diversify away from some of this AI trade. And what we watch is leading indicators of the economy. We watch inflation expectations. We watch where the Fed is ultimately likely to go. And all of that suggested to us a broadening of a market and a weaker dollar.
As we think about investors rotating into what I would call old economy sectors and stocks, whether that is transports, regional banks, chemicals, oil and gas. And I think there is a good reason for that. And this week's rise in PMI, looking at manufacturing activity, expanded at the fastest pace in over 3 years. So there is hope that we're seeing a turn in the industrial cycle after a long period of stagnation.
So obviously, Dave, a lot of different opinions in there about what to do now. I mean, the other thing that traditionally people would have done now was to go into safe havens, or what they perceive as safe havens. But if you look at the traditional havens, obviously gold and silver have been incredibly volatile. Bitcoin, which was seen by some as a store of value, has not been a very good store of value. So what do people do now?
Yeah, I mean, even in those clips, you can see the dichotomy of opinions and sort of some of the confusion, I think, that's settled into markets, at least for the time being. And where I think investors are rightfully so looking for other opportunities, right? Most people have identified the AI trade. From my perspective, whether we're talking about retail investors or institutional investors, not a lot of folks have been looking at staples and energy, which are the two best performing sectors year to date. Interesting pairing, though, because, of course, staples more of a traditional defensive sector. Energy less so, much more cyclical, because at the same time, if you look at the economic data, as one of those other guests said in the clip, it actually has been improving, even though it certainly does not feel that way. Then you have the challenger job cuts data really questioning people about sort of the health of the economy. So I think investors really, especially with sort of some of those technical factors that I mentioned earlier, pull back pretty hard. I think net, of course, because of metals, particularly gold and silver, have become a bit of the momentum trade, are not providing that store of value really in the last couple of weeks. But over time, I do think investors do want to have a more diversified, broader portfolio. Those are areas which are traditionally uncorrelated to stocks and can be very valuable for investors' portfolio. And at the same time, I think a lot of folks don't continue not to recognize this. Non-US investments have done particularly well over the last year. And maybe if we look going forward, there could be further opportunities there too. So there's still areas of the market that remain undervalued, that provide sort of the potential on a go-forward basis. But because everyone has been so focused on sort of AI disruption and some of the adjacent themes that can come from that, I think investors have maybe over-allocated to those areas. And what we're seeing on one hand is a bit of a rational pullback from that, a reassessment, particularly to your earlier point, that it's really difficult to ascertain exactly what impact is Claude and other AI sort of models going to come out to really disrupt business models going forward.
Software is getting slammed. Dan Ives over at Wedbush telling clients the software Armageddon is here. Dan always has an ear for the dramatic, of course. What do you make of it? I mean, do you look at this and say, Rishi, and this is the sector you know so well, do you say, you know what, this reaction, it's fair, it's reasonable, or do you say this is an overreaction, mass hysteria? Where are you on this?
Yeah, and I hate to give out the cop-out answer, but the answer is it's somewhere in between. There is reality behind all this AI hype. I see all the new announcements out of Claude and OpenAI, and I'm just spellbound how amazing this technology is and how quickly it's evolving. At the same time, I think this idea that AI is the death of software is absolutely wrong. And I would say as a whole, this pullback is a huge overreaction. I think it's presenting some really great buying opportunities, but I think we need to put on our thinking caps and really scrutinize what are the companies that are going to recover the best. Like, this is the opportunity to invest in quality. Quality doesn't mean size. Quality means innovation. That is the biggest moat I think we have now.
And is the central concern here, Rishi, if we boil it down, that we think companies are now going to build their own unique, powerful AI agents, and they're going to perform the work of the traditional software tools? Is that it?
I think it's a combination of two things. One of them is exactly that you can use these vibe coding tools, you can use Cursor, Claude Code to build your own CRM, or at the very least, don't unplug your CRM, but all the functionality around it, you can surround it with your own custom-built AI agents. The second worry is that a lot of this functionality will get subsumed into OpenAI and Anthropic as platforms. You saw this morning, Anthropic made a bunch of new announcements, sent what was viewed as the more insulated area of software, cybersecurity, sent a bunch of those stocks down this morning because they talked about security.
On that news, I wanted to touch on with you on that anyway. OpenAI, so let's just bring viewers up to speed. They launched a new enterprise platform called Frontier. That is Sam Altman going hard after those business customers. Initial customers include some names you know very well, Intuit, right? Then Anthropic, its latest AI model, per Axios, looks like an inflection point, they say, for how AI tools can help cyber defenders. When you see these headlines dropping from OpenAI, from Anthropic, how do you try to think through, okay, what this means for the software sector?
Yeah, I would say two things. Number one is, well, what is the value of all of these LLMs and all this AI technology if it's not actually being productized at the application level? And one company can't do everything. They can't know sales and marketing in depth. They can't know financials in depth, and especially vertical, if we think about industry-specific software. So that's piece number one that I would say. Piece number two is, this almost reminds me of the early days of AWS, where every time AWS would make an announcement, it would send all these software stocks down 10, 15%. Guess what? Amazon has a good observability solution. Datadog's still doing incredibly well. They have a database. MongoDB is still doing really well. They have a data warehouse. Snowflake is still doing really well. And I think we need to think about this. It's not a zero-sum game. And all of this is actually TAM expansive. The amount of money we as a society spend on software is going to grow meaningfully because we can do so many things we couldn't do before in a more efficient manner. And I think that's going to come out of OpEx.
So as we think through this as investors, listen, we're forecasting, we're estimating, we're bringing out our crystal balls. But when you went through this earnings season, right, you were going through the conference calls, you were listening to the results of these software names, Rishi. Were you seeing actual hard downward revisions? Were you hearing CEOs and CFOs saying, I am cutting guidance because of AI?
I'm glad you bring that up. In spite of how apocalyptic this may feel, numbers aren't coming down. Numbers are actually going up. My Microsoft numbers went up. My colleague who covers ServiceNow, his numbers went up, right? And that was the day that led to kind of this most recent stage of bleeding. And that tells me that this is all terminal value risk. In other words—
And what do you mean by that, terminal value risk?
Yeah. Ultimately, what it's telling me is investors are effectively thinking these will turn into shrinking businesses. They may be growing now, they may be growing next year, but you're at the valuations that we're looking at for some of these names, you have to assume that they're going to be declining by 5% in perpetuity, which I think is highly, highly unlikely no matter what happens. And that's where I think it's creating some bargain opportunities. But if you can get something where it's pricing in that kind of black swan scenario, but also has innovation where the opportunities with AI massively outweigh the threats, then I think there's really—
It's tough though, Rishi, because you can have a story take hold. Yes. You can have a narrative take hold. And AI is the death of software. If that story takes hold, it overwhelms the fundamentals. What do you do with that as an investor?
Yeah, absolutely. No, that's exactly right. And look, the story a year ago was AI is going to be the biggest tailwind for all of software in human history, right? And we've seen how quickly these narratives can reverse course. Look, what I think needs to happen is we can build our shopping list. We don't necessarily have to pull the trigger right now. No one knows how to call the bottom. But what I would say is this: as we start to see evidence of these innovative companies that actually can not only build AI SKUs, but actually get customers to use them, to get value out of them, to get them to spend more time in their platform, not less, as a result of this, that's a great leading indicator for future monetization.
Let's end here with some places where you say, you know what, there is opportunity. Let's go through some names quickly. HubSpot. Now that is down, Rishi, about 70% over the past 12 months. One, what explains that shelling? Two, why do you say this one's a buy?
Yeah, absolutely. So HubSpot is down because it's SMB software, it's sales and marketing, there's worries about seat-based models, all of that sort of stuff. I take a step back and I say, look, I understand that. There are real threats here. SMBs are more likely to build their own solutions or at least switch. At the same time, I think HubSpot has so much innovation at their backs. They have a unified platform that combines sales, marketing, service, commerce, operations, all organically built on a single platform, which means a single data layer that makes all the AI very actionable. I think they've put real thought leadership. They were talking about agent marketplaces before any of us were. And so I think the opportunities for them hugely outweigh the threats.
What about MongoDB? Now it's dropped around 20% this year. Most analysts who cover this one do like it. They say it's a buy. You do too. How come?
I think MongoDB presents a very flexible database that is going to be the platform of choice for building these net new AI applications, especially those leveraging unstructured data. And that tailwind has not shown up in numbers yet. But they already have Cursor as a customer, Relevance AI as a customer. They just signed Anthropic as a customer. And so a lot of these leading AI companies, I think, will turn to MongoDB because they present the best standalone non-relational database out there.
Finally, I'll squeeze one last one here. Intuit, down around 30% already this year, rough. You say buy it.
I think this is one of those where the opportunities are huge. If I think about the core TurboTax, yes, there are going to be a subset of people who say, I'm just going to use free tax software and use ChatGPT or Claude to help me through it. But the opportunity to have AI embedded in TurboTax to start disrupting H&R Block, to start disrupting your CPA down the street. Same with QuickBooks, the ability for Intuit to build agents that can actually help you close your books faster, more accurately, and save money in that process, maybe not even need an external third-party accountant. I think those opportunities are huge, and Intuit, I think, is an innovative company.
Rishi, it is always great to see you, especially live in person on set. Thank you, my friend.
Thank you.
You got a buy rating still on this stock, Angelo, but there was a lot of disappointment here, particularly in the company's bread and butter smartphone business, which is under pressure because of the inability to get memory chips into these phones. So, this really seems to be a big challenge for the industry overall. How bad is it, do you think, and how long is it going to last?
Yeah, Julie. So, thanks for having me. It's pretty bad right now, right? I mean, you kind of look at how constrained we are. I mean, you kind of laid it out nicely, but you think about where all that memory demand is going right now. Look no further than Alphabet's results last night and the boost in CapEx plans, right? That's really the issue at hand right now. It's the fact that you're getting all this memory capacity really kind of devoted to the data center AI infrastructure builds. And as a result, if you're on the PC or the smartphone side of things, you're getting hit really hard. When you look at what's happening with Qualcomm here on a sequential basis, you're looking at handsets dropping north of 20%. Let's call it about nearly 13 to 15% on a year-over-year basis in terms of decline. The good thing is we've now seen this reset on the expectations, and you kind of look ahead. It's probably likely going to remain pretty weak here. We'd say over the next 6 to 8 quarters at least, as far as the memory bottlenecks are concerned, before you really get any notable help. And again, that's gonna hurt Qualcomm, especially given that they do have a lot of business at the low end of the channel, where a lot of those pressures are being felt. On top of that, they are losing ongoing Apple business, which continues to wind down. So they're hitting it all over the place in their core business. The good thing is they are diversifying, and that really is the core story here. If you are a bull, you're getting a very value, cheap play here with a long-term trajectory in terms of new emerging markets.
I guess the question is how long term? Like, how long do you have to wait, Angelo? Because if you look at those other sources of revenue, right, which have been growing quickly, and that has been the company's whole strategy. For example, the automotive business, $1.1 billion in revenue in the quarter, so it broke above $1 billion for the first time. But phone revenue is almost $8 billion. So, you put all those non-phone things together, how long is it going to take for it to ramp up?
Yeah, it's a great question. And what I would say here is, listen, the bad thing about being a value investor or looking at value names in the tech space is sometimes it takes longer than you want to wait, right? And as far as Qualcomm is concerned, what we've told investors is you have to be patient with this. I will say this, last quarter, let's call it about 25, 26% of their revenue within kind of their manufacturing, chip-related manufacturing business came from non-handset revenue. Given the plunge that we're seeing here in handsets this quarter, let's call it about 35% or so of their revenue will come outside of handsets. And we do think within the next 2 to 3 years, that number grows to at least 50%. So on the top line, you may not see much growth there. Not to mention there is potential upside to our expectations. For instance, they are getting in areas like data centers, where if they were to announce some big customer wins, that could provide upside, right, to expectations. So I'd say at this point in time, the valuation plus the fact that, hey, listen, there is line of sight here over the next couple of years. And I know, listen, nobody wants to be talking about 6G because that's towards the end of the decade. but that's also, another opportunity for the company long term. So there are opportunities out there, especially when you look at the valuation. You've got to be patient if you're an investor.
So I am curious then, Angelo, if you're looking at Qualcomm versus some of the other chip makers, particularly say a Broadcom right now, yes, obviously you're saying you want to own this name, but is there other stuff where you're seeing maybe more opportunity in the short to medium term?
Yeah, I mean, listen, I think, this is a really interesting market right now. I mean, I think you kind of started off talking about some of these software names, and, there are other type of names, that we have really been punished here over the last couple of weeks within the tech arena. And I think the concern really is kind of what does the tail look like in a new AI-induced environment? Not necessarily what's going to happen in 2026, because the earnings trajectory looks pretty good for tech in this year. It's more along the lines of what's going to happen, beyond 2027. And when we start looking at maybe some of the tails with the companies within semis that may have a longer tail, I would look at a name like an AMD that just got punished here yesterday. I know it continues to be beaten down here, but it's a name that we think will turn around and has some really good opportunities tied to them as they start getting into these large-scale rack solutions. I do understand the fact that, hey, listen, can some of this CapEx momentum be sustained and maybe avoid, some of these other AI-type plays? But AMD is one where I think you can get that AI play and maybe, that long tail tied to it.
Angela, you also cover Alphabet, so I got to ask you about that one, because there too we are seeing some selling pressure. How much of it is what we heard from Alphabet? How much of it is the concerns you alluded to, right? The bigger concerns that seem to be plaguing tech right now.
I think for Alphabet, listen, I mean, it just had an insane run here going into the print. I mean, it's trading at about a 25% premium to Microsoft. So you've got that, going against them. Not to mention on top of that, that CapEx number was absolutely monstrous. I mean, they're essentially pointing to a doubling here year over year. That's going to really destroy the free cash flow expectations here over the next couple of years. So essentially, virtually most of the cash from operations at this point in time being reinvested in that business. So don't expect, any significant buybacks if you're an investor in this name. But that said, listen, that backlog growth that we're seeing from Alphabet really kind of warrants higher spending. So we'll see how this all plays out here over the next couple of years. But if they make do in terms of their promises from this higher spend, there's a really great growth story here to be looking at over the next 2 to 3 years.
I mean, Angelo, in general, do you think that this sell-off that we've seen more recently in tech is really giving a gift to investors who want to add to positions or enter positions?
I think a market like this gets very dangerous in the sense that, it's not necessary. You're not necessarily seeing the pullback here due to some adjustment factor in terms of earnings. It is, again, that long-term unknown as far as we kind of transition to this AI world. What I would tell investors, and I think what most people would agree with, is you do have to be a lot more selective in this type of environment. You do have to look at names that say, hey, listen, where are stories that can continue to grow in an environment here 3, 4, 5 years down the road, where we do have high conviction. A name like Alphabet is a great example of that, where maybe some of these SaaS-oriented names, get a little bit more difficult. So I do think there are some value traps in this market. I think there are also some great opportunities.
And you just named at least one of them, a couple of them for us. Angelo, thank you so much. Good to see you.
All right, thanks, Simon.
Let's start here. You say so far in 2026, you say almost everything is beating tech. Yeah. Of course, you're right. Of course, this year, what's been working? It's energy, it's materials. Yeah. So, do you look at that rotation, Gina, and you say, okay, this is real, it's sustainable, it's durable, or no, it's more of it's going to prove to be kind of a short-term trade?
Right.
What do you think?
I think it's incredibly unlikely that everything wins except for tech. I think instead, over the course of 2026, we probably see a little bit more discernment between winners and losers. We start to see things like in the earnings season, one of the things that we looked for in earnings was financials, looked a little ahead of its skis. We were overconfident in terms of financials valuations back well beyond multi-year highs. We're indicating that maybe financials were a bit overpriced. Financials has become a little bit of a weak player. Likewise, it's very unlikely that you see energy and material stocks perform well and consumer stocks perform well in the same time period, because usually when energy and material stocks are performing well, it's because costs are increasing, commodity prices are increasing, and that tends to be something of a depressant on the consumer
That was an
sectors.
interesting theme I thought in your notes, and just elaborate, because that was an interesting trend.
Yeah.
You talked about this sort of commodities versus consumer.
Yeah, it's almost inevitable that it's either or. It's very rare that you see the consumer rallying and performing very well. For instance, when oil prices are elevated, they spend more at the pump, therefore they have less to spend on discretionary items, right? So it's very simplistic, but nonetheless, it's in the cycle. You generally either see commodities leadership or you could see consumer leadership. The one sector that kind of rides in the middle that I think nobody's really talking about is in industrials. And industrials indeed are sitting at very elevated valuations, but they are beneficiaries of rising commodity costs to some degree. They're also beneficiaries of tax reform in that any company that is going to spend on long-dated investment gets to immediately expense that investment over the course of this year and next and into perpetuity now. That is a big benefit to the industrials companies that are dependent upon that long-dated spending. So industrials tend to, I think there's a reason why industrials have performed so well and have kind of fallen beneath the radar, if you will. They're breaking out higher, at least until the last couple of days of market weakness. That industrial sector is also a big part of the small cap space. It tends to get ignored somewhat in the large cap index, but it's a sector that has done reasonably well in small caps too. And then the other thing that I would say about industrials, where it's just kind of flying beneath the radar, is it's defense spending. When you have this multi-decade potential reset in defense spending, given geopolitical risks globally, industrials may be a pretty big beneficiary of that. So that's the one segment that I'm watching really carefully is maybe this is the one that endures, but otherwise it's either an inflation trade or a consumer trade. You've kind of got to pick one or the other.
Yeah. Let me ask you, on staples, some folks were sort of looking at people moving into staples, and I heard some investors saying, to them, because that's defensive, the fact that people were moving there, they sort of saw that, Gina, as kind of like a yellow flag. I was just wondering if that's how you see it.
It is. Staples do not outperform in an up market. It's just it's one of the just golden rules of the S&P 500 is if you're overweight staples, then you're inherently suggesting some degree of defensive bias. Staples do very well in a down market or in a weak market because they're a low beta sector. Utilities used to have this status. Utilities has become very interesting because unlike staples, utilities has become a derivative play on AI. Utilities has been the recipient of tech, and it's a little bit more offensive. Still low beta, but I think that element of the tech tie has sort of weighed on utilities a bit more, at least recently. But staples is more of a pure play defensive strategy. Now you have days like today where staples, you have earnings that have been somewhat disappointing from Estee Lauder, for example, and that may weigh a little bit on the staples sector, but generally they don't even need earnings. In an environment where stocks are selling off, staples as a low beta play tend to perform pretty well.
Interested to just get your broad take on mega cap tech.
Yeah.
The earnings, also just the divergent reactions have been interesting. So investors, they like what they heard from Mark Zuckerberg at Meta. He gets rewarded. Microsoft and Alphabet, not so much. We got Amazon after the bell today. What do you make of it?
Some of it is just what was embedded in expectations. I think that's a really important. The setup for each of these companies coming into earnings season is always a key component of the stock price reaction after earnings. Nonetheless, two really big themes kind of have emerged in big cap tech, and that is how much are you spending on CapEx, and how much is that going to deplete your margin outlook in an environment where you still have relatively strong revenue growth, but how much revenue growth are you getting? And that's where Microsoft fell short. I think that's what the market is a little bit nervous about with respect to Amazon is cloud has become a really big part of the revenue line, has been a really big part of the theme, sort of the thematic driver of why you invest in these entities. And Microsoft disappointed the market in terms of cloud revenue. That may happen with Amazon. I think that's why you see this weakness coming for Amazon. There's a little bit of nervousness there. So that's the revenue side. And then the CapEx side is really clear. We saw that with Alphabet, certainly. We may see that across more companies throughout the tech sector is how much investment do you need to have?
And I did a double take on that
long-term
Alphabet.
margin?
That CapEx forecast, as much as $185 billion, I thought I read it wrong at first. I mean,
Right.
it's hard to get your head around these kind of numbers.
It is, and remember, this is what really started to dismantle the tech trade last fall, is the capital spending idea. And now we've got capital spending as a core issue combined with revenue growth as a core issue, combined with AI implementation, taking out the potential growth rates for some of the weaker players inside the space as well. So there's multiple channels that are hitting tech all at the same time. Broadly, that's a reflection of the fact that tech valuations, frankly, just flew too close to the sun. You very rarely get to a point where multiples for tech are commanding a 40% premium to the market. As a matter of fact, over the long haul, in the middle of a cycle, tech stocks command 0 premium relative to the market. But we commanded a premium of 40%. That's something you only saw back in the tech bubble. It does suggest that there is some speculative excess likely that has become embedded in these stocks as, frankly, they've beaten expectations, constantly raised those expectations, and then that creates this higher and higher expectation embedded in stock prices. It's almost impossible for the companies to satisfy that no matter how well they do. And so the market starts picking away at these small weaknesses, and I think that's what we're seeing today.
I want to get you out of here on this, on a comment you made about the Fed, Gina. You say, even without more rate cuts, the Fed is still easy. Yeah. In plain English, explain what you mean by that, and then what that means for stocks and bonds.
Yeah, so if you just look at the status of Fed policy, where should it be? One way to think about that is to utilize the Taylor rule, which really just takes pure economic conditions between growth and inflation and says, what is a reasonable expectation for the Fed funds rate? You compare that to the Fed funds rate over time. Over long periods of history, we've averaged a Fed funds rate that's about 1.5 percentage points below the Taylor rule. Currently, we're 2 percentage points below the Taylor rule on the Fed funds rate. So in theory, that would mean that we are easy relative to long-term history based on the run rate of economic conditions and inflationary pressures. The Fed is in a state of easy relative to the long-term trends. What does that mean for stocks? Practically, it usually means over the long run, you get a slightly better rate of return on stocks over a 12-month period. When the Fed is easy, you get an average annualized return of about 8%. When the Fed is tight, in the opposite position, where the Fed funds rate is above the Taylor rule, you tend to have much lower returns. Your average long-term return is closer to 4%. So just from a status of monetary policy, it's helpful to keep in mind in the back of your head that liquidity conditions are still pretty supportive. The Fed is still on the side, operating on the side of the market, probably going to ease if the president has his way, and if Warsh fulfills his stated objectives. We may see another easing as early as June, according to the market, and that usually is pretty helpful to the equity market. Right now, we're in a reset, certainly, because we've become a little bit excessive in terms of expectations and speculation, in particular with respect to tech, and earnings are really struggling to satisfy those expectations. But longer run, it's important to keep in mind that monetary support is still there.
Gina, so great to see you, especially on set. Thank you for your help today.
Thank you. Thank you for having me.
Well, U.S. futures are lower as investors digest this week's tech sell-off. Joining us now, Angelo Korkafis. He's a senior global investment strategist at Edward Jones. Angelo, we have seen this tech sell-off, and we have also seen a rotation into lots of other stuff, sort of cyclicals, old economy kind of names. Do you expect that sort of movement to continue? Do you think tech will continue to be under pressure?
Yeah, I think rotation remains a dominant theme for markets this year as we think about investors rotating into what I would call old economy sectors and stocks, whether that is transports, regional banks, chemicals, oil and gas. And I think there is a good reason for that. And this week's rise in PMI, looking at manufacturing activity, expanded at the fastest pace in over 3 years. So there is hope that we're seeing a turn in the industrial cycle after a long period of stagnation. I think that provides some promise. And this is happening at the same time as the momentum moves away from some of the more growthy, speculative parts of the market. So I think this is a healthy development and potentially has some legs.
Well, I guess, Angelo, the problem is it's a healthy development, maybe, but like the market can't rally without tech, I guess is the issue. I mean, there was a note that Julian Emanuel over at Evercore ISI came out with that pointed that out, that we've got between tech, communication services, and consumer discretionary, which has Amazon in it, that's 54% of the S&P 500. So if that stuff is not going up, the S&P can't go up. So how do you think about, the rotation being healthy without, tech kind of has to participate, doesn't it?
Yeah, that issue of high concentration is the reason why we see the equal weighted S&P outperforming the market capitalization S&P. Small caps, mid caps are outperforming. The reason why I call it healthy is that while technology stocks continue to deliver strong earnings and results, what that has translated into is basically earnings rising faster than prices and valuations getting cheaper. It's been more than a year that the technology sector has not seen valuation expansion. So at some point, there's going to be some bargains, and technology remains one of the key drivers, really, for the earnings growth for the S&P. But now, there is an alternative, meaning that before there was no earnings growth from the rest of the market, and there is one now. I don't think this decline in technology stocks is going to be becoming something deeper necessarily, but it is a dynamic that we are watching. We have seen indiscriminate selling in software stocks. And at some point, there's going to be some winners and some losers. Not all of these software stocks are going to be disrupted by AI. It is hard to now differentiate who are going to be the winners, who the losers. So participating and looking for some bargains in a diversified way makes a lot of sense. So we don't think tech is going away, but there is some positive thrust for parts of the market that have been unloved for a long time.
I mean, they've been a lot more loved this year, at least some of those groups, right? Energy has certainly done well this year. Industrial is doing pretty well this year. Is there one or two of those groups in particular that you think is especially well poised to continue to outperform this year?
We like industrials. The industrial sector has very different end markets that are all participating in the industrial upcycle. We also like consumer discretionary. In the first half of this year, we're going to see some of the tax refunds benefit and support consumer spending. And then we also like healthcare as a sector that has been out of favor and potentially has some upside. So we're not recommending to underweight tech, but we are spreading out some of our exposures, and we see that cyclical upturn acceleration benefiting sectors like industrials.
Angela, what do you think about the sort of macro backdrop here? Because traditionally, a sector like industrials or some of the other cyclicals would be doing well because there is an expanding economy. But at the same time, yes, we saw strong GDP growth late last year, but we're in this sort of sluggish labor market. Do you think that is going to start to be reflected in growth as the year goes on?
Yeah, I think the low hiring, low firing conditions in the labor market will probably persist. But at the same time, corporate profits are rising. We are seeing above trend growth. And it's not only AI CapEx spending driven. It has been the consumer really pushing this economy higher. And that is the key reason behind the resilience. We're talking about a slowdown, no doubt a cooling in the labor market, but incomes remain supported by rising wages that outpace inflation. So even though necessarily we have seen the so-called K-shaped economy with the high-income cohorts doing a lot better and accounting for most of the spending, at the same time, we don't see any catalyst, either looking at companies that remain very profitable, they don't have necessarily a reason to really provide grand-scale layoffs, or at the same time, we have multiple levers in the economy that are starting to work, including the industrial and manufacturing side that has been in, let's call it, recession most for the past 3 years.
And then I know you, like many investors now, are looking outside of the U.S. as well, right? I mean, that trade has had a bit of a run already, but it feels like people are kind of sticking with it.
Yes, we think about one of the most lasting drivers of returns being earnings. We are seeing an earnings acceleration outside of the US, similar to the industrials here in the US, where we have seen really manufacturing sluggish environment for the past 3 years. That's been the case also abroad for other indices. And now that is starting a bit to change. The US dollar weakness has been a key driver behind the outperformance, but it's not the only one. And we are looking for a potentially range-bound to slightly weaker dollar, which should continue to benefit those international asset classes. And as we talk about tech, we still have many AI companies that are located abroad and are still part of that AI build-out story that trade at lower valuations. So I think there are some credible reasons for international diversification to really be a key part of investors' portfolios this year.
Yeah, and certainly that has been working well. Angelo, thank you. Appreciate it.
Thank you.
Big picture, Adam, you're neutral on equities and you're underweight U.S. versus international. Maybe start there. Help me just understand that, your positioning here, Adam.
Absolutely. Well, we've been overweight international for about a year now, and we still like that play. You know, last year we were talking about how there was kind of this peak U.S. exceptionalism. People were starting to wonder why you still own international in the first place. And we were talking about valuations being attractive overseas, and we just needed a catalyst. And last year we started to see it with more spending. We saw a lot of rate cuts from overseas central banks. And now, as we're starting to see this fragile state within the AI trade, we're looking at international, where in the S&P 500, you have 34% of the index is tied to technology. It's less than half that overseas. And so I think that's just one more catalyst in support of looking overseas. And so we are maintaining that overweight position.
I take your point, Adam, that the AI trade looking a bit more fragile here, tech under pressure clearly. But what's interesting, Adam, it looks like folks are, they're not ducking and running for cover. They're kind of, all right, they're ducking out of tech, but then it feels like they're rotating, right? They're finding new trades, new ideas, new opportunities, a broadening. Is that how you see it or no?
Absolutely. And look, I never like to see red on the screen, but what I do like about the current market is you look at the intraday lows today. We did recover into the close a little bit, but the intraday lows, 70% of the S&P 500 was trading up. And so this is not a case where we're seeing this indiscriminate selling. This is really targeted. This is something that is really confined to technology primarily. We saw semis really sell off today. It was software yesterday. And so this is more targeted selling where people are selling first. They're going to ask questions later. But in the meantime, they're focusing on quality and those other areas that maybe aren't as exciting as AI. And that's okay, because boring can still be good in this environment.
It was interesting, Adam. I had Morgan Stanley's Adam Pauker on the show earlier today, and we were having a discussion about valuation and just how he thinks about valuation, how he would characterize valuation. He told me he thinks valuation can actually stay supported around current levels. He told me valuation actually tends to expand when earnings growth is strong, so above the historical median, and the Fed's accommodative. I'm just wondering, what do you make of those comments? Do you agree, disagree? What do you think?
Yeah, look, I would agree that valuations can remain at these levels. Whether they have much more room to expand, I think that's a question mark. I think that instead we need for earnings to grow into valuations. I think to sustain and justify the current valuations where we are, call it 22, 23 times on a forward PE basis for the S&P 500, we need to deliver on expectations for 14% or so earnings growth in 2026. So I think that's going to be really critical. We've been talking a lot about what could go wrong and what can go right. That's what's going to drive the market here. And so that's really explains why we are neutral. We think that we can certainly point to upside catalysts for the S&P 500 and for the broader markets, but we can also point to a number of risks as well.
We just heard from Alphabet. Looks like the stock edging lower here, down about 2% in the after hours. We'll have Amazon on deck tomorrow. You're underweight the Mag 7. How come? What are the key risks there? Is that earnings growth, Adam? Is that valuation? What do you see?
Yeah, it's both, certainly. And we've been underweight for several months now. And we've been telling our clients, look, you can express your belief or optimism around the AI trade, it doesn't mean you have to own the index weight. And I think that's really important, that we could be deliberate in our positioning. We're not, we don't have a mutual fund where we have to really focus too much on tracking here. I think it's important to pick and choose your spots. And so as we focus on the Magnificent Seven, we're looking at a group where we've seen operating margins expand by double digits, by about 10% over the last 3 years. You have to ask yourself how much further that can go as we start to see people start to question all the investment going into this, and we see new competition. We see these companies starting to leapfrog each other. And so that's one of the reasons that we're just focused away from it. We think that they are still profitable, they're still printing cash, but we also want to focus beyond the Mag 7, and we think that that's where the opportunity lies.
You also say here, Adam, you're preparing your clients for more volatility ahead. How do you prepare them? I mean, how do you keep them sort of just focused and disciplined, even if we see drawdowns?
Yeah, it's we really try hard. I think it's really important first to just state the facts. We're coming off 3 very good years for risk assets, focusing on the S&P 500, cumulative returns of close to 80%, back-to-back-to-back years of 15% plus returns. And so I think just stating the facts and the current landscape, we can all acknowledge the geopolitical risks, but let's also just look at the calendar here. It's a midterm election year. Historically, those are more volatile. You see average intra-year drawdowns of close to 19% versus 12% in years 1, 3, and 4. So right there's likely to be more volatility here. And I think it's really about hammering it and focusing on that long-term financial plan, which we do for all of our clients, and saying, look, your portfolio, your financial plan is built to withstand short-term periods of volatility. If we do see a little bit of a stumble, that's okay. It's healthy. And as long as our economic outlook remains favorable and earnings continue to deliver, we think that any sell-off will be relatively short-lived.
Adam, great to have you on the show today. Thank you.
Thank you.
Let's start with your year-end target here, Andrew. You're constructive, my friend. You got 7,800 for the SPX. You see earnings growth of 17% this year. Maybe start there. That earnings growth you see, Andrew.
Yeah.
Narrow, broad. What do you forecast?
So we forecast a broad 17% earnings growth this year, and the main driver, Josh, is the return of positive operating leverage. So we've seen over the last couple of years is that cost structures have compressed, really since 2022, mm-hmm. and that's mainly a result of a second derivative deceleration on compensation expense. At the same time, we started to see pricing power and top line firming, and that's a powerful setup for earnings growth for the average stock, for cyclical areas of the market, and for small cap equities. I think holistically, this is the best earnings setup that we've seen since 2020 into 2021.
What do you make of this market, Andrew? Because there had been a narrative that, big tech had to hold in there or the market would fall apart. You heard that storyline. Big tech has been under pressure, but it sounds like, folks, they're finding new trades, new opportunities. And I'm just curious what you make of that trend.
Well, I mean, the broadening is playing out even on a day like today, as you pointed out at the open. 70% of S&P members are up on the day. We're seeing areas like transports, like housing-related stocks, certain pockets within consumer, regional banks that are not just outperforming the broader market, but are up significantly in absolute terms. And that to us is a broadening that's playing out. And I'll give you probably the best piece of evidence that we have from our perspective that this fundamental story is ongoing, which is that earnings growth for the median stock in the Russell 3000 right now, so broad index, is up 13% on a year-over-year basis. That's the best growth that we've seen in 4 years. So this is a leadership base that is broadening beyond sort of the prior mega cap leaders.
How would you characterize valuation here?
So valuation is extended from a historical standpoint, no question about that. I think there's a few variables to consider for why valuation can stay supported around current levels, around 22 times forward earnings. So number one, the median stock in the S&P trades at a 3-turn discount to the cap-weighted index. So if we're right on a broadening in leadership playing out this year, driven by that positive operating leverage dynamic, that margin dynamic, we should see a catch-up from the median stock valuation to the cap-weighted index valuation. Number two, for all the talk about mega cap tech market multiples and valuation, the Mag 7 forward P has actually not expanded since the beginning of 2023. We can go back to the end of 22 when ChatGPT came out, actually didn't expand since that period. And then lastly, a back test that we've run is historically when earnings growth is above the long-term median, so above 8% on a year-over-year basis, and the Fed funds rate is down on a year-over-year basis, both of which are our house views for this year, the market multiple on the S&P expands 90% of the time, 90% of the time. So I think that those are some counters to the idea that valuation in and of itself is elevated.
In terms of where you see opportunity, Andrew, small caps and consumer discretionary, what's the common theme or themes that explain why those two would work in this backdrop?
So for consumer discretionary, we like it on the good side in particular. We're starting to see unit demand improvement. We're starting to see pricing improvement. The relative earnings revisions for that space has improved quite a bit over the last several months. In addition to that, we have a fiscal tailwind this year, $65 billion fiscal tailwind. A lot of that's going to hit in the first quarter of 2026. Household balance sheets are strong in aggregate, and that's a trade that's out of consensus from a sentiment and a positioning perspective. And then on small caps, look, the S&P 600 small cap index is seeing 10% earnings growth right now. That's the best growth that we've seen since 2022. It's up from negative 5% 1 year ago. And then we talked about valuation before, Josh. That S&P 600 small cap index trades at a 7-turn discount to large cap equities in the S&P 500.
You talk consumer discretionary. Consumer staples is interesting. I want to get your take on this, Andrew. Some folks said, Jared pointed out at the top how folks have been piling in there year to date. And I've heard some investors say, well, that's a defensive sector. And they almost say the fact that it's working so well is kind of like a yellow flag to them. Is that how you see it or no?
So, I mean, I would say from a relative performance standpoint, consumer discretionary, particularly on the good side, has been hanging in there from a performance perspective this year. Staples to us is a more defensive cohort. So we would gear more pro-cyclically towards consumer discretionary. That's where the earnings revisions have been stronger, and that's where the fiscal tailwind is likely to play through as well in our view.
Tech under pressure. I had another investor sitting in that seat, Andrew, this week, and he said he's avoiding tech. Even though it's been a bit beat up here, he says too richly valued still. Is that how you see it?
So we see it a little bit differently. The fundamental setup for large cap tech, whether you're looking at the tech sector or Mag 7 or NASDAQ 100, remains intact from our perspective. Those stocks in aggregate have been trading with the revenue revisions, and what do the revenue revisions just do? Just accelerated to 20-year highs. At the same time, you have the valuation dynamic that I mentioned before. The forward multiple for that cohort has not expanded since the beginning of 2023. So there really isn't the valuation excess. It's been all a forward earnings story. I would also mention that the market is still rewarding high capex to sales behavior, not just for the tech sector, but for the broader S&P 500. And so that, I think, benefits the AI enablers and the hyperscalers. And then one last thought there, we're also focused on the AI adopter trade. So we have about 40 basis points of margin expansion in our 2026 earnings numbers from the AI adoption momentum that's going on. And a lot of that's concentrated in services areas of the equity market, financial services, consumer services, healthcare services. And our analysts have done a lot of work at the stock level to identify what those names are.
In terms of sectors you would be underweight, Andrew, what would those be?
So it would be the defensive cohorts that we talked about before. So we're officially underweight consumer staples and real estate. I think that there's some bifurcations in other sectors as well. Like, for instance, within consumer discretionary, we've voiced a goods over services preference. The reason is that we're starting to see wallet share shift from services to goods for the first time in 4 or 5 years. So remember, after COVID, massive overinvestment or overconsumption cycle in terms of the goods economy, consumers were stuck at home with excess savings. And so now that's starting to flow the other way, where we went to services, now we're going back to goods.
As for the Fed, you say the nomination of Warsh, you point out, Andrew, say it doesn't impact the rate path near term. I think we have odds from Polymarket we can actually show on that, kind of a split they show between 2 and 3 cuts over there. Curious to get your take though, Andrew. What's the House view? How many cuts in 2026?
So the House view is 2 cuts still in the back half of this year. I think the generally muted reaction to the Warsh nomination in and of itself makes sense to me, as does the cyclical leadership. The early tell there was from early December to mid-December, when Warsh's odds went up for the first time. Cyclicals led the market, small caps continued to lead. It was economically sensitive areas. So the reaction that we've seen over the last few days very much fits with what happened during that period. And then the other questions are around the balance sheet.
Yep.
And there our economists are of the view that changes to the balance sheet under a Warsh-led Fed likely come in a deliberate fashion over the next year or two.
If you did shrink the balance sheet, can I just, before we get out of it, you remove that liquidity, what would that mean potentially for the stock market?
Well, I mean, for certain liquidity-sensitive asset classes and pockets of the equity market, like a speculative growth type of pocket of the equity market, it would have more of an impact. One thing that I want to highlight, though, that I think actually matters the most from a near-term liquidity perspective, so the Treasury General account has been built back up, and that's been sort of sucking liquidity out of the system. Over the next couple of months, as tax refunds are paid out, that will actually be a positive liquidity impulse. And I think will ultimately be more important for the market in the near term and those liquidity-sensitive asset classes and pockets, more so than the Warsh news in and of itself.
Andrew, great to have you on the show today, especially on set. Thank you.
Thanks for having me, Josh.
And you can scan the QR code on your screen to check out Yahoo Finance's Predictions Market Hub, powered by Polymarket.
I'm coming to you after a big sell-off yesterday on fears like this. Where is your head?
Well, listen, I run a software company, so I'm all in on software. That's where my head's at. But from a trader side, I mean, I kind of like it. Isn't this an opportunity? Isn't this what we all kind of dream about as investors or as traders? You know, you want high volatility, lower prices, lower basis, and it gives you more upside, doesn't it?
Tom, you're the man. All right, so you have been in the software business for a long time. Let's go there. You are operating a software company. How are you trying to compete with AI companies?
Well, this is my third software company. We built two financial brokerage firms, and I've been in fintech now for almost 40 years. I just roll with it. So what we're doing now with this latest software company is we've just embedded a lot of AI into our technology. So it's kind of like, I really don't get it. I kind of agree with Jensen in a way that I don't understand where the pressure is coming from, other than a lot of these stocks were too hyped and too overpriced. But it's pretty easy as a software company to embed a lot of the new AI tools and functionality and all the features, and it's relatively cheap to do, and it's relatively easy, and it doesn't have a long lead time. So I just think that full integration, that's how we're addressing it.
Quick plug to the new Yahoo Scout. Love me some Yahoo Scout, Brooke. I use this thing around the clock now. Use it on Yahoo Finance. Stuff is awesome. But Brooke, I mentioned at the top of the show, these sell-offs have gotten pretty serious too. Really, and it's not just the likes of legal names. I mean, it's really started to spread yesterday, more so to a Salesforce, a ServiceNow, or ServiceNow, these companies that already have been pounded year to date.
Yes, certainly. As you showed earlier within the show, all these software stocks largely in the red to kick off today's trading session. And also earlier this week, Piper Sandler downgraded a few stocks there, Adobe, Freshworks, Vertex, and that really sort of gained momentum as we're making our way into this middle of the week. And on top of that, too, a lot of this rhetoric that we're hearing from the street is kind of like, I told you so. JP Morgan out with a note this morning saying that over the past 3 years, they've been warning their clients that this could happen, that the AI is essentially coming for software here. They essentially said within the note that it's changing fast, that it could seriously change the landscape of software companies, and that these companies even need to evolve even more so than what they already have been trying to do. And on top of that, too, they even said that they ran multiple quote-unquote death of software webinars to get investors ahead of this. And so was there a bubble within the software? Like Tom said, were these valuations a little too hot for the street to handle? And now are we seeing a pullback as investors try to digest and understand where these software stocks stand as we move forward in a world where AI has just become more and more prominent towards the end of 2025 and really ramping up and serious implications moving into 2026?
Tom, back to you. Look, these companies, software companies that got hit double digits yesterday, they're not going out of business today or tomorrow. But what is your buy signal on a company, let's say for Thomson Reuters? I mean, they're so dominant in their field, and I'm just not to single them out, but companies like that, what do you need to see as a trader?
Well, there's a couple things. So as a trader, you want to see and again, not everybody follows volatility, but what you really want to see is some capitulation. And nobody knows, really nobody knows price. In other words, so it's very subjective. So when stocks get too cheap, it's completely subjective whether or not that's a bottom or whatever. But when you can see a lot of selling pressure, which comes in the form of really high volatility, which just is expected move. So when you get really high volatility and you see a lot of selling pressure, which you can see in volume, then you start to get to the point where you're like, okay, this looks like it's some form of capitulation. And as a trader and or investor, it doesn't matter. That's where you want to jump in. I mean, the challenge right now is that you've got a generation of traders and investors that have never seen a down move. And I'm a grizzly old trader that's been around.
Come on, Tom. You're still a young guy.
I mean, I traded in the '87 crash, so I'm very familiar with little sell-off. So I'm okay with this. But I think there's a lot of people out there, Brian, that have never even seen a down move, and they're looking at this like, oh man, look at this, 20%. Who cares? It's just an opportunity.
Was yesterday, Tom? Was that a mini crash?
No, No, that was not a mini crash. I would say, if you want to say the closest thing to a mini crash, probably would have been silver and gold last Friday. That was the closest thing you get to like a kind of a mini crash type thing. But no, no, that was not a mini crash. But yesterday was really interesting because there's a lot of stocks that, especially in the fintech space, but the key is you need liquidity. Don't get involved in stuff that doesn't have liquidity. If it has liquidity, sure, you can nibble anywhere.
Where are we in the AI trade? It feels like we're in a new phase, a more skeptical phase, although we had little bursts of that last year. But this year it feels like that's kind of settled in a little bit more.
Yeah, I think you're right, Julie. And I actually think that's good news, because if there wasn't skepticism, you really could make a case for a bubble. And so the question now becomes, is software dead? Is the AI adoption going to make money? We listen to every company earnings call, and names we own and some names we don't own. So across economic sectors, and we are seeing that the adoption of AI is pretty robust from companies. The spending is still very low as a percentage of their total tech budget. So we think we're still early innings, but that doesn't mean the stocks are going to go straight up. They had a nice run last year. One of the names we added last year was Google, which reports this week, as you know. Well, actually, we added it in the summer of 2024 when the valuation was moribund. And, that turned out to be a good decision for us in our value portfolio, believe it or not. And you might recall it was in the Russell 1000 Value Index. So you just have to sit tight, pick your spots, and then really challenge the conventional wisdom. IBM reported last week their software business is growing at a rapid clip. They're seeing increasing interest in their software business in terms of platform, cloud orchestration. So we think there's some opportunities in names that have gotten beaten up where you can step in if you have a 3 to 5 year time horizon.
Well, speaking of names that have gotten beaten up more recently, but which have still gone way up over the past year, Palantir, which is reporting after the close, and which is a controversial stock, to say the least, in no small part because of its, forget about the fundamentals and what it does, because of its valuation, it's also controversial, Nancy. Is that one that you guys own, and what are you looking for from those numbers?
We do own it, and I think what we've observed, all of us investors, is that if you step back and look at the company 3 years ago, it was sort of top secret, didn't really know who the clients were or the end customer. Now what you're seeing is a much more public defense posture, and the U.S. Army just made an announcement that the business, they're going to center their platform on Palantir. And so I think with an increased interest in defense names, this is one that you want to own it. You just don't want it to be the largest holding in your portfolio because it is so volatile and because the valuation is so lofty. But, I've used this example with you before. The question always becomes, in a stock like Amazon that had no earnings for many years, Palantir was in a similar position. When was it too late to buy Amazon? The thing's up 175,000% since its IPO. So if you're buying transformative technology companies, you want to use volatility as your friend. We were buying Palantir at $88 a share last spring during the tariff tantrum. So you get the volatility, and that can be an opportunity if you're a long-term investor. So we're going to be watching for guidance. I mean, that's really the most important thing in this earnings season is what do these companies expect for 2026?
Nancy, I think the question that you just mentioned that you said that we've talked about before, I think is one of the most important questions for investors who are looking at technology, which is, yes, the upside can be, if not unlimited, very large if it is a transformative technology. I guess the trick is figuring out if it's a transformative technology. So how do you do that? How do you know with a fair degree of certainty that it does rise to that level?
Well, we spend a lot of time looking at management and understanding the management team. Think of it as a quarterback on a football team. We want the very best CEOs because they have the ability to pivot and manage expectations correctly and also market the company. So if you think about an Elon Musk who's long on hyperbole, maybe a little bit short on timing of his, meeting his time horizons, but he's still a transformative CEO who is focused on the future. We own Tesla. I don't think you can own enough Tesla, but Palantir is another one of those names, sort of an outspoken CEO. He is the company in many people's eyes. And so, that can drive volatility as well. But rest assured, Julie, we don't get them all right. I mean, one of our 12 best ideas is ServiceNow, and it just hasn't felt very best idea-ish. But I do think the CEO is outstanding. We have added to it on weakness, and we will continue to do so.
So let's talk about those precious metals first, because obviously it has been almost unprecedented, the moves that we've been seeing in gold and silver over the past few sessions. And how much is it fundamentals and how much is it speculation, and can we separate them, and then how does that inform how you trade them?
Yeah, it's been very entertaining. So we have to go back roughly 4 decades to see similar types of moves. If we look at silver, for example, the Hunt brothers, when they cornered the market, we saw kind of similar intraday moves. But as a backdrop, you have to remember there's never been more money in the system than the current environment. It's never been easier to trade via technology. And we have sort of the proliferation of leveraged instruments, options, all this type of stuff. So market moves and volatility are increasing. So if we look at sort of the catalyst on Friday, obviously the Kevin Warsh news, he's viewed as sort of a hawkish pick by the market. I believe he'll be more pragmatic. It's really his views on the balance sheet and quantitative tightening. So he actually does support lower rates, but he wants to reverse basically what Bernanke had done via the wealth effect and asset price inflation through QEs, right? So you get rate cuts, but the view is that it's triggered through the asset channel and lower asset prices.
So in other words, all that money that you talked about that's out in the system, some of that comes back, or some of that is shrunk.
Well, if he followed through on his prior statements, yeah, it would be a negative for asset prices, and then we get rate cuts in response to that. Now, it's unlikely that we'll go down that path. And then, of course, there was month-end effects. There was a large option expiry as well. So if we look at, kind of where we're at, so we had this large correction, but structurally, especially the case for gold, is still very compelling, okay? So we look at it, if we sort of rewind the clock a little bit, it was the Biden-era sanctions that led central banks to de-dollarize. And of course, geopolitical risks are rising. Investors are looking for stores of value. So we're seeing central banks buy a significant amount of gold. And if we look at the headlines overnight, President Xi has come out and said that he wants the RMB to be a global reserve currency. And China has been a very large buyer of gold. The Polish central bank recently just bought 150 tons. Another very interesting development there is actually the crypto community. So Tether has a gold-backed stablecoin. They own 140 tons of gold, and they're doing physical settlement. So they're storing the gold in vaults in Switzerland. And they're purchasing on the order of 2 to 4 tons a week of gold. Then, of course, institutions are underowned, and the world is really sort of scrambling to find an asset that will perform in this type of environment, again, where the geopolitics are rising, and we have sort of broad debasement of currencies, right? So we're looking for an anti-dollar.
So I guess I would go back then to my first question, which is, okay, so you have all of this fundamental buying of dollar, but then you have on top of that the leverage bets, the options, the speculation. So what is the fair value? How do you even determine where gold prices should be just based on the fundamental demand? Because that other stuff can come and go.
Yeah, so it's of course very hard to disentangle those effects. A firm like ours is a systematic manager, so we incorporate many types of ideas in the strategies, from fundamentals to very technical and more pattern-driven types of inefficiencies in the market. But clearly it's an underowned asset. You have this marginal demand through these large players. So it's really something that I expect will continue to perform. And if we look at 2025, gold was up 65%, silver was up 140%. We had a very torrid start to the year in both. And these types of price dynamics, it's very interesting, right? Because they're sort of very hard to there's a wide range of outcomes potentially. But longer term, if it's sized correctly in a diversified portfolio, it just makes a lot of sense.
Now, when you say it's under-owned, you mean by institutions? Because it seems like the latest leg up has been, at least in part, retail-driven.
Yes, absolutely. But if we look at institutional investors globally, gold is, again, not a large allocation, right? So investment committees will be looking at it, thinking about it, whether it makes sense in their portfolio. And of course, gold is a less liquid market than, say, the S&P. So again, from a flow perspective, if we get sort of a shift in psychology on ownership of gold, that can lead to very explosive price action, which is partly what we're seeing.
Now, when you talk about the world trying to look for an alternative to the dollar, why has it been lately that gold has been that and Bitcoin has not?
Yeah, so this is a sort of a struggle, right? And one of the use cases of Bitcoin was that it would be a store of value. Markets are a lot about narratives. So there is like a horse race to figure out which asset will have those properties in a world where currencies get debased, right? So clearly, with the recent moves in Bitcoin, it's much more correlated to the stock market, particularly technology stocks. And it's just not emerging as a potential candidate for that, which is interesting because we could see more rotation out of the crypto industry into kind of the more traditional rails like gold. Now, silver is not something that's owned by central banks. It's more speculative. The interesting bit there is that it's actually tied to the AI build-out. So solar panels, 94% of solar panels actually use silver as an input. And prior to the run in prices, it was about 3% of the cost of a solar panel. That's now gone up to about 40%.
Wow.
So there's this sort of like indirect link to the data center build out, all the CapEx, et cetera. But central banks are not buying silver. So if you really want sort of a good candidate for something that will protect your purchasing power, the rising geopolitical risk globally, it's pretty clear that gold is emerging as that candidate.
Since you've brought up tech a few times, so I do want to ask you about that. I mean, when you're talking about silver prices going up, we know memory chip prices have been going up, costs have been going up for the data center build out. So how do you think about that in the context of your ownership of tech stocks and your strategy around tech stocks?
Yeah, so investors have to be more selective about where they go in that value chain, okay? Now, the thing is, we just had earnings, right? So we have the CapEx projections from, say, the large hyperscalers. Like if you look at Microsoft, Google, Amazon, Meta, they're going to spend $460 billion in 2026. So for investors, there's all these pockets of value, and you really want to focus on the inputs into the data center build-out, where firms have moats and a lot of pricing power. So memory is a really interesting one. So OpenAI secured 40% of the global DRAM market in October. And if you look at data centers that use a certain type of memory, it's called high bandwidth memory, HBM. There's only 3 companies in the world that can produce it at scale. One is in the US, it's called Micron. The other 2 are in Korea, SK Hynix and Samsung. And if we look at the KOSPI, last year it was up 90%. It's selling off today, but it's up 25% again this year. And what's interesting about that is they have an enormous amount of pricing power. So memory prices are going up on the order of 50 to 100% every single month because the demand is insatiable. And there's a lot of spillover effects related to that. So consumer electronics, and we saw it on the Apple earnings call. There were questions around the cost of manufacturing the iPhone and concerns about their ability to secure memory. So there's all these sort of spillover effects tied to the AI narrative and this data center build out. But if investors can find these firms that have that pricing power and they're a core input into the investment, there's still a lot of value fundamentally in those companies.
Well, and it's really interesting you say that because it's not as though this Micron situation is a secret. The stock has already soared, right? And you're seeing the hard disk drive makers that are also adjacent to the memory business, SanDisk, Western Digital, et cetera. All of them are at or near records, but there's still room to go up.
Yeah, so what's interesting about that is they're re-rating their earnings so quickly that the forward multiples are coming down. So we're in this memory super cycle effectively, and I don't see that changing in the foreseeable future. This AI build out will happen. It's the largest industrial investment cycle in the United States since World War II, right? And a significant contributor to GDP as well.
Are there other places besides the memory, are there other sort of emergent places that you think investors should be looking that are tied to that sort of picks and shovels of AI?
Yeah, it's the picks and shovel. That's a great way to describe it. You really want to focus on these inputs that are specialized, and there's just a massive backlog in terms of order books. So another one is transformers. just to power the data centers. It turns out that a lot of European companies like ABB, companies like that are very specialized in the manufacture of these types of inputs. And again, that's like another pocket of value potentially where they have a lot of pricing power and they can pass that through. And again, the CapEx is just going up and up and up. There's this big push on this technology. The spending is going to happen.
Christian, really interesting stuff. Thanks for coming in. It's good
Thank
to
you,
see
Julie.
Appreciate
It's great
it.
to see you.